The lobbies are still open. The teller windows still move. But the numbers behind the counters have already turned. Deregulation arrived in 1982. It removed the ceiling on deposit rates. The floor on risk remained unexamined. Institutions began competing for deposits they could not safely deploy. Capital flowed where oversight had not yet followed. Federal deposit insurance covered each account. The premium structure did not account for the new risk profile beneath it. Depositors had no reason to scrutinize. The guarantee was real. The obligation backing it was not yet visible. Thrift institutions moved into commercial real estate. This was new territory. The expertise to price it correctly did not transfer automatically. Regulators operated with reduced staff. Examination cycles stretched. The interval between visits grew quietly longer. The first institutions began showing losses. The insurance fund absorbed them. Absorption continued without public accounting. Capital moved toward high-yield instruments. Risk was repackaged into forms that still carried the institutional name. Some institutions grew very fast. Growth itself was taken as evidence of health. The distinction between scale and stability was not enforced. Real estate values in certain regions began softening. The collateral under existing loans began quietly losing its stated value. Appraisals during this period were not independent. The institutions commissioning them were also the institutions holding the risk. Political pressure constrained early regulatory action. The interval between identified strain and institutional response continued to widen. The insurance fund's reserves were drawn down. The agency managing it continued normal operations. No public signal was issued. Families held deposits in these institutions. The guarantee remained. The institution holding their savings did not always remain solvent. By the mid-1980s, hundreds of institutions were operating with negative net worth. They remained open. Deposits continued arriving. Regulators called these institutions zombie thrifts. They could not be closed. Closing required funds the insurance agency did not have. So, they remained open. Each day of operation added new deposits to an institution that could not return them without external support. The burden was transferring to the federal government. The process was quiet. No mechanism existed to make it visible in real time. Loan portfolios in failing institutions continued accumulating. New loans were extended to service old ones. The delay was institutional and deliberate. Workers at healthy institutions could not distinguish themselves from failing ones. The external signals had been suppressed too long. The commercial real estate market in Texas and the Southwest contracted. Entire portfolios revalued downward. The gap became structural. Senior examiners filed findings. The findings sat in agency review queues. The queue did not shorten. The institutions continued operating. What recorded history reveals is often less than what occurred. These systems generated cost before they generated attention. By 1987, the insurance agency acknowledged insolvency. The acknowledgement was technical. The operational posture remained unchanged. The total cost of the crisis was still accruing. Each month of delayed closure added to the ultimate obligation carried by the public. Retirees and working families carried deposits in failed institutions. Federal resolution protected the principal. It did not protect the years. Congress passed the Financial Institutions Reform Act in 1989. The framework that had allowed the crisis to accumulate was formally acknowledged and replaced. The Resolution Trust Corporation was created to manage the failed assets. It inherited thousands of properties. Most had already lost significant value. Acquired properties moved through a disposition process spanning years. Communities in affected regions lived alongside the physical evidence of institutional failure. The total fiscal cost reached approximately $160 billion. This was public obligation. It was distributed across the tax base without a direct invoice. Resolution trust operations extended into the mid-1990s. Although the machinery of aftermath ran longer than the crisis that produced it. The examiners who had filed early warnings remained inside the same agencies. Their conclusions had arrived correctly. The response had arrived late. Some institutions that failed had grown specifically because of the guarantee beneath them. The guarantee had functioned as an incentive for the behavior it was meant to contain. Congressional hearings into the crisis ran for several years. The record accumulated. The accountability it produced was uneven and incomplete. Workers who had drawn salaries from failed institutions moved on. The communities where those institutions had operated adjusted more slowly. The insurance structure was redesigned. Risk-based premiums were introduced. The system that had existed before was not resurrected. Its cost persisted. Surviving institutions absorbed the failed ones in many cases. Scale transferred. The concentration of the industry increased as its breadth contracted. The thrift industry's share of the mortgage market declined and did not recover. The failure had restructured the landscape that contained it. The institutional memory of why the original regulations existed had eroded before the crisis arrived. Deregulation moved faster than institutional understanding could follow. The savings and loan crisis became a reference point in regulatory literature. It was studied. Its structural conditions were replicated in other sectors within a decade. The institutions that failed are gone. The mechanism that allowed them to grow after insolvency is documented. The documentation did not prevent repetition. New institutions occupy similar functions today. The underlying guarantee structure persists in modified form. The underlying question about its limits has not been resolved. The cost still moves through the fiscal record. It is distributed across obligations that do not announce themselves as legacy. They are simply present. The windows at the remaining institutions still open each morning. The guarantee behind them still holds. The question of what holds the guarantee remains open.